Well, hello everybody and welcome back to the oil and gas rundown here at King Operating. We are super excited to have you joining us today. And of course, as always, we are going to be sharing some news in the oil and gas industry, as well as giving you some information on how this very interesting industry actually works. And today, of course, we have our CEO and founder, Jay Young, with us. We have EVP of Land and Business Development here at King Operating, Bill Phillips, and we have our EVP of Tax, Rex Gifford, with us. So we are excited today to get right into it and share some information with you. You know, Jay, it's been a very busy, this is the fourth quarter, and that means that it is tax planning time. This is an urgency in tax planning. And, you know, we always advise people, hey, don't wait till the end of the year, you know, to start looking at your 2025 tax strategy, but a lot
Yeah.
of people do. So this is a busy time for us. And, you know, as everything is signaling that the long-term demand in oil and gas is going to be strong and consistent over the next few years, it really makes oil and gas and tax strategy and your tax strategy investment so strong at this time. So busy time for us, Jay.
It really is, and there's nobody better to talk tax than Rex Gifford. I mean, he's the
Oh
authority
my.
in tax. He's incredible. He's been with us for 20 years. He's a great guy, and he knows taxes like the back of his hand. If you don't believe it, just ask him. He'll tell you the tax code of everything from shoe leather to oil and gas and intangible drilling costs, and we love it, and we love Rex. But he's really good. He's been with me for a long time, but he's also been with the IRS. He's a great tax guy. Don't invest in oil and gas for the write-off. Don't do that. But it is a great segue into
Yep.
making money. You know, if you find the right deal, you got to find the right deal. And that's why I wrote the book, The Upside of Oil and Gas Investing, because I wanted investors to see an upside more than just a tax write-off, which a lot of them, they increase their advertising budgets 10 times with this time of year because they know that people like tax benefits and they're going to invest. My thought is, hey, you know what? They're all oil and gas deals, tax write-offs are the same, unfortunately. The thing is, who can make you money? And that's why I'm looking at our project, and the three buckets that we have that we're looking at for doing that is very simple, but it's also building a business. How do you build businesses and bring your clients along with them? And private equity. That's why I call ourselves a private equity firm. We're a private equity firm. Participating in the oil and gas business to grow assets and do exactly what institutions did at one time. They're still doing it. We're doing it for the high net worth individuals. So it's a completely different type of strategy than oil and gas companies have, and we're different in that sense. And that's why we really appreciate if you give us give us a look when you're looking for that write off. So that's
Yeah,
the good news.
absolutely, Jay. We always say, like, yeah, exactly what you said. The tax benefits are there, but you need a very good investment. Put it where you're going to have a steady cash flow. And with us, you're going to actually look at getting a multiple on your capital invested. You get to take part in the divestiture. And that's really what brings you in to the oil and gas sector in a very special way as a retail investor, where private equity has been doing this. Jay Young has come up with a way for you to also take part in the deal, which is truly amazing. So that's our busy time of year, Jay. And, you know, we would welcome you if you want more information on tax strategies, on IDCs, on oil and gas investing, and what we do here at King. Please reach out to us. Go to kingoperating.com, shoot us an email, send a comment down below. You can comment below if you're watching this on YouTube or LinkedIn, and we'll get in touch
Mm-hmm.
with you. So, Jay, let's talk a little bit about what's going on around the world. And I see that ADNOC, the CEO, Sultan Al Jaber, is recently stated that global oil demand will remain above 100 million barrels per day beyond 2040, signaling that the company sees a long horizon for oil demand rather than an imminent peak. And I totally agree with him. He also pointed out that while the near term volatility and headwinds are real, the long term outlook is positive for every form of energy across the market. What do you think about that, Jay?
Yeah, I definitely agree. And we've had a lot of economists, from John Malden to others, that have looked at what we're doing or what's going on with the oil and gas business. And I mean, for a second, think about it. A third of a barrel of oil goes to gasoline cars. A third goes to, trucking, air transportation, jet fuel. A third goes to other products. So there's a lot of items that are needed for oil. And oil is such an incredible commodity, and there's so much money in oil that we're going to see prices go up and down, but we're not going to see them go away anytime soon. And that's why I feel like that, with our production going down in the United States, which I feel like it will in 2026, end of this year or first of next year, production is going to go down. When it goes down, we're going to see higher prices. So, hey, buy low, sell high. This is a great time right now. I did see that about, what they're talking about with peak oil demand. And, I don't think we're going to have peak oil demand, meaning that the demand for oil will continue to go up. It's not going to go down. People think, because we have electric cars, we're going to see demand just bottom out or something. And we don't see that because there's so many different products that are needed for oil, and we're going to need oil for a long time. And so we're going to see that, continue to go up.
Yeah, I completely agree, Jay. I think that, kind of this notion or this idea that, we were going to transition from oil and gas into renewable is really a thing of the past. And the reality has kind of come forward and hit us all in the face that that's not a transition. There's not going to be a transition away from oil and gas. Renewables can make a great accompaniment in certain areas, but oil and gas is definitely here to stay. And especially with the rise of new technologies, we are not seeing that. We're not seeing oil and gas going anywhere in the near future. So
right.
Absolutely. Jay, how are you seeing this kind of long-term demand influencing the deal sourcing and investor interest right now?
Yeah. Well, there's always going to be demand for projects like what we're doing in the Mid-Continent or the Bivens, which, Bill can tell you about the Bivens project and how well things are going there and our developmental plans there. But there's going to be public companies that are always going to be looking for assets, which is what we do. We take them from the very beginning and increase the value in a project, and then we sell them off to a public oil and gas company for them to take them to the next level. I mean, you're around in first and second with us. You're going to, we'll leave a lot of locations for oil and gas companies to come in, increase the value by drilling additional wells and having that cash flow that we'll be able to sell to them. So in our business, it's never been a better time to look for an investment like with us, because we're going to develop assets in areas that we increase the value, we sell to a public company. But like I said, if you say, I don't know, I'm thinking about a lot of chicken on the bone. I mean, we don't sell it to where production is going to start going down. We make projects to where we are looking at a project to where, like Bivens Ranch, we've drilled 2 wells out there. We have gas flares. We have oil, 300-400 barrels a day right now, over 1 million cubic feet of gas. We're developing that. It's just 6-7% of the waters come out since we fracked them, and we'll drill 15-20 wells out there, and then we'll divest it to another company because we have 80 to 100 or more locations. So we'll show somebody, hey, we're developing. We've got $3 to $4 million a month in positive cash flow, which a public company likes, and we've got 50 to 60 locations that you can drill in the future. And we've drilled all around it to show them exactly where to drill, how to drill them. And, of course, they're going to say they could do better, which is great. Fine, just buy it from us at a good price so our investors can make money. And that's why Fund 3 is Fund 3 is a really good investment for our partners, because we have 3 different assets like this that we're going to develop and then sell to a public company. And there's always going to be the need for this. Public companies are always looking for acquisitions. they want acquisitions because they want to grow their balance sheets. They can't do it all the time organically, but they can do it, by acquisitions. And there's a lot of acquisitions that were done last week. I think there was a $700 million project. There was $1.5 billion. I mean, there's all over the board. And the reason why is because public companies want to look at our assets just like ours. So that's what we're doing right now. And we're developing assets for public companies. It's not going to go away soon. That's the greatest thing about what we do and how we do it for our investors. So as you can tell, I'm really excited about that. We participate as a family in the fund, and we'll continue to do that. And I feel like anybody out there that's a credit investor that's looking for monthly income, tax benefits, and you have to do just because you have all these, or you're looking for a multiple, a 3-to-1, 4-to-1 multiple on your investment is what we're looking to achieve, and our financials show exactly that in Fund 3. So I'm excited about it. I know this is the tax one, but just to share what we do, and when I wrote the book, which is over my left shoulder, left shoulder, got a camera and I can't. Upside of Oil and Gas Investing. If you would like an autographed copy of my book, well, the next 5 people, I'll be glad to send you a autographed copy of my book for you to have at your house, but to read it. It's about my family, about our legacy, and about what we're going to do for the investor, which is the most important thing, that we have anything going on. And Rachel, I know we've talked about this one-on-one about how much I care about the investors, and that's why I wrote the book, and I spent the money with Forbes and the whole 9 yards, is because I want the investor to make money.
Yeah, absolutely. And like we said, with the growing demand and on the horizon, a continued need for oil and gas energy, it's a great time to consider being involved in an oil and gas investment. So again, as Jay said, definitely reach out to us, put some comments below, or reach out to us through email. We'll definitely reach out and get more information to you. So thank you so much, Jay. We're gonna get Bill involved here and talk to him a little bit about the land. I know you're gonna jump off. You got somewhere to be. So thanks, Jay.
Thank you very much.
He's a man with lots of engagements, so he's got to head out today. But Bill, we're going to bring you in, and some of our viewers have definitely already seen you before on here with us, Bill. So welcome back.
Thank you. Glad to be here as always.
Thank you so much. All right, Bill, we're going to talk a little bit about, some of the biggest misconceptions that investors or the public might have about, land and mineral rights in the oil and gas industry. What are some of those main, misconceptions that you think are out there?
Well, there's several. Probably the 2 biggest ones is a lot of people think that when you drill an oil or gas well, the oil is in a big underground pool, and you just drill in to the top of the pool and produce oil. And that's not true. You drill where you think the oil and gas will be, but underground it's in very compact rocks. And if you actually saw a core of of any oil and gas property, you would naturally think, how in the world does oil or gas come out of that rock? And it's pretty amazing when you see these cores, and you need 2 things. You need porosity and permeability. And porosity is the amount of pore space within the rock. Permeability are those little pore spaces connected. So that's how oil and gas gets in the rock, and we can retrieve it up through the surface and produce it. And when you frack a well, you're creating more permeability in the rocks themselves to allow more oil and gas to come up. One other big misconception is what are the mineral rights and who owns them? And we could talk a long time about that. Which we don't have a lot of time to do. So I will tell you that, up until the minerals were, the oil or gas was discovered, whoever owned the surface of the land, as a general rule, owned all the minerals beneath it. And prior to oil and gas or coal mining, it really didn't matter who owned the minerals because you couldn't get to them. Well, since you were able to drill wells and penetrate the surface of the earth to go down several thousands of feet and now go horizontal many more thousands of feet, who owns all that? And once the minerals are, if the surface owner hasn't sold anything, he still owns all the minerals. But when the mineral owner or the surface owner actually sells half of his interest in the minerals or something like that, then you have two separate estates, the surface estate and the mineral estate. And if, for example, a family of four, when the husband and wife die, if generally they leave their estate to their kids, and now you might have two kids owning what just one family or one person did, so it splits, but you have a surface estate and a mineral estate. And then you ask the question, okay, well, if I own the minerals, but I don't own any of the surface, how do I get to them? Well, the common law rule is, in the U.S. that came from the British is, the surface owner, or the mineral owner rather, has the right to the use of his minerals in the simplest form, and the only way to do that is to drill a well. The only way to do that is from the surface, so the surface owner generally cannot prohibit a mineral owner from the enjoyment of his minerals. So in our case, companies will go out and lease the minerals, so you don't have, because the wells are so expensive to drill, you don't have the mineral owner drilling his own minerals, so they will lease it to us or to Chevron, Conoco, Phillips, and they will drill the minerals, or drill for the minerals rather. But the surface owner can't prohibit the mineral estate owner, in this case now Chevron or Exxon or King, from drilling a well on their property. There is, however, since 1971, a Texas Supreme Court's case that says, well, that's true, but the two have to work together, and it's called the accommodation doctrine. And not to get in the weeds, but this mineral owner has to work with the surface owner so that he just can't come in and drill wherever the heck he wants. They have to work together. So the other thing to be aware of is that all states are very, very similar in that the mineral estate is dominant, meaning it's dominant over the surface. But some states have surface statutes that say, prescribe, dictate how much, when you drill a well, how much damages you pay to the surface owner. Some have pretty robust figures, some don't have any. Texas is a state that does not have damage statutes on the books. States like North and South Dakota do, and some of the Rocky Mountain states do. So you have to be very aware of what state you're in and the rules and regulations that pertain to that. So I don't know if that's a little much into the weeds, but what it tells you is whatever state you operate in, you have to be steeped in the rules and regulations of that state.
Yeah, no, that answered a lot of questions, Bill. That was very, very good. And I think it is really interesting that depending on which state you are in, that is the rules, the regulations, the legalities are different. And, you know, Texas is very much, I think, if I'm correct in saying, very favorable, treats the mineral owners very favorable in Texas.
Right.
Yeah.
So it also makes a difference as to whether the states minerals are owned in fee or by you and I, for example, and Rex and other individuals, or like in New Mexico and Wyoming, you have a lot of the federal agencies own the minerals, like the BLM. Some state schools own minerals. Um, in Texas, the General Land Office of the state owns minerals. The University of Texas System owns minerals out in West Texas. So you just don't go out and poke a hole without knowing where you are and what the heck you're doing.
Yeah.
If anybody has any questions about that, I'm always available to help out.
Love that, Bill. So
Well, I
yeah.
got a question for you.
Oh no, Rex has got a question.
So
What is it, Rex?
my understanding is the defining difference between the business model of sponsored programs such as King Operating Partners 3LP by King and other sponsors is the difference between what oil and gas minerals are as far as ownership versus a wellbore only mineral interest. Can you please explain that difference?
Well, it's the difference would be, Rex, a wellbore only is typically not a mineral interest. It's where one company drills a well on someone else's land. So say King drilled a well on a lease that Exxon owned, and all we earned in drilling the well is a wellbore only. So we only own that portion of the wellbore encased in casing and tubing as you go out in the lateral. We don't own the lease around it. We would have all rights to the production that's produced into that wellbore, but we would not own the lease around it. We just own put a straw into a milkshake. You can suck as much out of that milkshake as you want, but when you put the straw in, all you own is the straw, and you don't own the rest of it until it's produced. Now that's
So if you own oil and gas mineral rights and you sell them as part of a group of producing wells, then you receive all the sales proceeds, correct?
From that producing well, yes, but you could not, if that well was on a 640 acre tract, you would not own the lease to the entire 640 acres.
Well, I'm taking the converse.
Produced from the well.
I'm taking the converse position. Assuming that you owned all the oil and gas lease rights, then if you had a divestiture in that scenario, you as the mineral owner would receive all of the sales proceeds.
You would receive, right, you would run reserves on that well and determine what the reserves are applicable to that well, and when it's sold, every drop of oil or MCF of gas that's produced, the buyer would own that, and the proceeds would go back to us and our owners.
Thank you for that distinction.
That's probably clear as mud, but when you get into the weeds, that's kind of what mud is like. It's a lot of little particles in there.
Bill, I always enjoy hearing about your guys' line of work, especially on the land side. It's really interesting. And of course, that's where a lot of the fantasy and Hollywood loves to, embrace the landman. And, Rex, I'm sorry they don't give you as much attention in Hollywood for the oil and gas tax guy. But I will definitely give you some attention today and jump over to talk about, the tax side of oil and gas and the IDCs and kind of breaking down the tax benefits that are part of our glorious industry. So do you want to jump in, Rex, and just give people kind of a high level view of, if they're expecting a large tax liability in 2025, how can they use oil and gas to navigate that and to turn this into an actual wealth building opportunity?
Well, again, the biggest distinction in the economic model that King uses is the investing entity, that being the LP, owns all of the oil and gas mineral rights, which that gives us the right to drill. So if you went to the courthouse and you looked under the oil and gas minerals, you would find the name of our partnership as owning those oil and gas mineral rights. So those are commonly referred to as leasehold assets. And that is the one item that you don't get a current deduction for. You basically expense or deduct the cost of the leasehold costs, or again, the right to drill, by depletion. And of course, there's two forms of depletion. There's cost depletion and percentage depletion. And each year, basically, the computations are made for both percentage depletion and cost depletion, and you deduct whichever is greater. And very simply put, percentage depletion is roughly 15% of the gross proceeds of sale during a calendar year of the hydrocarbons that are produced by the wells that you own. And cost depletion is basically the cost that you paid for those leasehold minerals multiplied by a fraction, and the fraction is basically the amount of oil that was produced during the calendar year is the numerator, and the denominator is the projected anticipated amount of recoverables at year end. But basically, for the most part, you recover the cost of the leasehold cost through, again, a deduction on an annual basis of the greater of percentage depletion or cost depletion. So what are we really looking for as far as trying to achieve tax savings? Is most investors or accredited investors are looking for, how do I save tax dollars today? So if you look at investing in oil and gas, there's two different approaches. There's active deductions or there's passive deductions. The passive deductions, of course, follow the passive loss rules under Section 469, and those losses basically are suspended and cannot be claimed as a current year deduction, and they remain suspended until sufficient passive income is received to absorb those losses. But most of us are all interested in the active deduction component. And so Code Section 469C3 basically says that you can attain active deductions as long as you become a general partner in the investing entity. Our preferred form of investing entity is a limited partnership. So we have an option once you subscribe to either be a general partner or a limited partner, again, depending upon what you're targeting, whether it be active deductions or passive deductions. So on the active deduction side, what we're trying to achieve is based on the capital contribution, active deductions equal to somewhere between 70 to 85% of a capital contribution. So just to make things simple, let's assume that that percentage is 80%. So if you contribute $100,000, then ideally you're going to receive active deductions of somewhere around $80,000. So that will give you a tax saving at a marginal tax rate of somewhere around $30,000 to $40,000, depending upon what your marginal tax rate happens to be. And in our scenario, what you have is the various components of that roughly 80% are driven by two particular items. One is intangible drilling costs, which can be defined basically as any kind of cost drilling wells or completing wells or stimulating wells that has no salvage value or something that you can't touch or feel. The alternative, of course, is tangible costs. And of course, normally that is tangible personal property. Now, with the enactment of the One Big Beautiful Bill as of July 4th of 2025 that President Trump signed into law on the tangible costs, what has occurred is in prior years for 2025, you were only able to expense 40% of the cost of tangibles. And then with the remaining 60%, you had to depreciate those over a 7-year life using Maker's depreciation method. But with the passage of the One Big Beautiful Bill, for all tangible equipment placed in service and acquired as of January 20th, 2025, you can now expense 100% of that cost. So what that provides for 2025 partners is that's going to increase the percent to where when we talk about this 70 to 85%, we're going to be able to attain closer to the 85% because we no longer have to capitalize a portion of the tangible cost. We're able to expense 100% of that. So today, again, effective January 20th of 2025, there really is no difference between intangible drilling costs or tangible costs because both of them represent 100% deduction.
Yeah,
so,
that's remarkable.
So this percentage, again, if you take 100% of the capital contribution and we're trying to achieve an 80% deduction, the 20% really represents what the partnership is paying for the leasehold costs. And that's the portion that we're not able to get a current deduction for. But again, that is expensed over time through depletion. So one of the other questions that we commonly receive is, once you receive a K1, where does it fit in my 1040? Well, typically, most accountants are very, very familiar with K1s. And basically, it goes on page 2 of Schedule E in Part 1 that covers partnerships and S corporations. And as long as you elect to be a general partner, then again, this is a non-passive loss. So it would appear in column I on that particular form, and it would show up as a non-passive reduction of your total income, which actually, if you followed it all the way through your 1040, you would see in line 8 as a negative number, assuming that this was the only partnership you were involved in, whatever that loss was. So going back to my example of $100,000, is you would see an $80,000 deduction on line 8, reducing, if you were making, say, $300,000 in other income, then your new total income would be $220,000.
Yeah, it's some would say possibly one of the best tax strategies for tapping into those active deductions on your total income, Rex, and actually being able to, like Jay said, not just have that deduction, but roll it into an investment, which is pretty incredible opportunity for people to be involved in, that you're going to see a substantial deduction on that tax form, but you're also going to put yourself in a position to create cash flow, to create a multiple on your investment for years to come. So yeah, really, really amazing. Rex, we got about 1 more minute left. Anything you want to throw in there that people need to know? We're coming to the end of the year. What type of urgency is there, Rex?
So really what you're doing is if you invest in the stock market and buy Exxon, for instance, you're going to spend $100,000. But if you spent $100,000 by subscribing to our program with the tax savings of, call it $30,000, your true net cost of participation is only $70,000 because of the tax savings. So the urgency is you want to grab the tax savings now, because if you miss the cutoff, most individuals are on a cash basis, and deductions for cash basis taxpayers normally are you're able to claim them once you pay them. So if you miss the December 31st deadline, then you've missed your opportunity to save taxes in 2025.
Yep. So you need to get in now. You do not want to be giving the government. Look, there's great things about the government. Okay. And I'm thankful for many of the things that they do and they provide. But there's no need to just hand them over your hard earned money that you've worked for, you've sacrificed for. You don't have to give them extra, right? We don't need to just hand over money that, you could actually put into an investment for your family and have a great strategy in place. So you've got to get it in. You've got to get your investment in before December 31st. And Rex, there will be people who send their investment on December 31st, won't there? They'll be sending it in
Unfortunately.
late. You don't have to do that. You actually could get in right now, make it a nice, easy process, get a hold of us. We'll definitely get you going in the right direction. So I want to thank you, gentlemen, for joining me today. Rex, thank you so much. Bill, thank you as always. And everybody, again, if you are interested in getting a copy of the Oil and Gas Rundown, please make sure to leave a comment in the section below or reach us through email. Any other questions, definitely reach out, kingoperating.com. We would love to connect with you. And of course, we will see you back here at the same time next week for the Oil and Gas Rundown. I'm Rachel Griffith. See you next time.